Hello and a warm welcome to Talking Stocks. I'm Kukule Tutsele. In studio with me, I'm joined by Sean Ashton and Liam Hector, who is from Anchor Capital. That's the both of them. Now today we're talking about Rand Merchant Insurance Holdings, also referred to as RMI Holdings. Now this is a listed insurance investment holding company that holds a diversified portfolio of premier insurance and investment products and also provides services to retail, commercial, corporate and public sector customers. Gentlemen, quite a company that I think a lot of South African consumers and citizens overall have had contact with, but RMI is the umbrella company, but lots of other assets at the bottom there, right, Sean?
Absolutely. So, I mean, the three principal assets would be Discovery, Outsurance and MMI. Now, Discovery, I think many people would have had access to via the health business. That's probably the obvious touch point for many consumers. And that's a 25% stake that they own in that business. They've also got an effective 25% in MMI, which is the Momentum business. And then they're the controlling shareholder for Outsurance, which is about an 84% holding that they've got there. And that's probably the single biggest chunk of value in terms of the contribution to RMI as a business.
And this is the only unlisted company that they actually have under the umbrella.
Company, yeah.
Walk us through the opportunities presented by Outsurance as well. I understand operating not only in South Africa, is it New Zealand and Australia too?
Yeah, so I think the more mature part of the business is in South Africa. They've been operating in this market for some time. It's the largest direct seller of largely short-term insurance products in the country. Becoming a bit more mature, we think that the short-term insurance business, in the case of Outsurance, can probably grow by between 7 and 8%. Over time, probably GDP plus a little bit, nominal GDP plus a little bit, but they've got a high market share here, and it's already a very profitable business, making about a 20% underwriting margin. But they've also gone into the Australian market and more recently the New Zealand market under the brand name UI, or UI as it's called. And currently they've got about a 3% market share in Australia, but they're writing about 7% of new business. So clearly this is a business that's got very, very long tail of growth to it.
Exactly. Looking at the different companies, one would think that automatically some of them might compete together, but I understand that's not actually the strategy. MMI more Africa focused, Outsurance, like you alluded, SA and other southern hemisphere based countries, and Discovery based in the UK as well as even an opportunity in China and US, right, Liam?
Well, that does excite us within the group, sort of the holding structure. So most of the growth that you're seeing within RMI is coming offshore. So if you look at Outsurance, the majority of their growth is coming from UI, which is in Australia, and then the majority of growth in Discovery is coming from the UK market. So in terms of hard currency earnings growth, if you want to classify the Aussie dollar as hard currency, most of it's coming from offshore. That excites us. In terms of whether or not there's possible cannibalization within the group, I think possibly with Discovery and Sure, they might be eating into the lunch of a company like Outsurance locally in South Africa a little bit. But ultimately, if you're in the if you're in the holding company structure, you're going to be getting the benefit on one side at least. In terms of looking at the structure, you've got about a third of your value is in Discovery, and then about half your value in Outsurance, and then the sort of remaining bits will be in that holding in MMI. Obviously, you can own MMI and Discovery on their own on the JSE. So our focus generally when we look at RMI is on Outsurance.
Let's come back to the group overall as an overview of the firm, the market cap as well as the PE ratio of this particular company. Is it fairly priced given, like you say, its subsidiaries as well on the local exchange?
So I think the way we look at it is we really enjoy the business of Discovery. We think it's got years of structural growth ahead of it. They operated disrupting in their markets. We enjoy the business. RMI at the beginning of this year started looking a bit pricey as Outsurance expected sort of a few catastrophic weather-related incidences that ultimately took quite a lot of earnings growth off. And now what our suggestion to most of our clients and portfolios is our sort of picture going forward is that Outsurance should outperform that of Discovery on a one to 2 year view in terms of earnings growth. So we probably see more relative value at the moment in RMI than purely in Discovery, and that's going to be our positioning. So we had the opposite view at the beginning of the year, and I think we came on Talking Stocks and spoke about that. and now our view is to sort of switch that around.
Let's touch on that opportunity. You did talk about UI as well as Outsurance really being where the growth opportunity lies, but the strategy and the numbers, do they all add up?
I think a reasonable way of looking at it is that when you're buying RMI today and you're applying Discovery and MMI at face value, in other words, the listed value that is on the exchange, at today's value for RMI, you're effectively getting Outsurance at about a forward 17 times P multiple. Now, it doesn't sound especially cheap, but when you consider growth assets, now that's a business that we think can grow by well north of 20% per annum for the next couple of years. And how does that come about? So that comes about through, within that you've got the short-term insurance business, as I mentioned earlier, in South Africa, which should grow, we think, 7 to 8% per annum. There's a small life insurance business it's not really meaningful, but it can kick a bit of growth through in South Africa. So South Africa is possibly a 10% growth business, let's say. And then outside of that, you've got UE, which is probably 45% of the revenue base of the entire Outsurance entity, but it's currently operating at break even. Now, what we think that they're likely to achieve over the next 3 to 4 years is possibly a 10% underwriting margin in Australia. And at the same time, you've got revenue growing at well north of 30% per annum because you're writing double the rate of new business that your existing market share is. So we think over the next couple of years, you've got explosive turnover growth in UE, and your profits, if they achieve what we think they can achieve, your profits could go from break even to possibly north of R1 billion over the next 3 or 4 years in UE itself. So the combination of all of that, when combined with the South African market, would leave you with an entity at the Outsurance level growing its earnings by probably 25% per annum. Now, a forward 17 PE growing at 25% that's pretty good value in our minds.
Exactly. Those are big numbers that you quote. So clearly the opportunity is still lying in there. But I want to throw a spanner in the works, which is the drought situation we have. And we know that there's quite a lot of agricultural business.
I'm glad you mentioned that.
Exactly. Isn't that a particular threat, though, to operations?
It's a big positive for them. And the reason being that they don't have the agricultural coverage. I'm talking specifically South Africa now, which is the bigger part of their business, right? Because right now you don't really have a profit base in Australia. But when you look at the South African business, they're not a big underwriter of agricultural risks. Their big business is underwriting auto and household structural and household items, etc. So very much short-term focus on the individual. Why is it a negative? So you don't have the big agricultural exposure. And secondly, a lack of rainfall is actually good for auto claims, because you don't have hailstorms, you don't have wet roads, etc. So you should actually expect to see a lower claims ratio in the auto business. So on balance, I think droughts are quite good for Outsurance as it currently is constituted. Not great news for the rest of the country, but it's for a short-term insurer, it's good news if you don't have a big agricultural book.
Exactly. Well, that takes away one level of concern at least. But let's come to a slide which gives us insight into the sum of the parts, which I understand is the important element that we need to look into when it comes to insurance companies. But Liam, how do they fare?
So at the moment, our fair value, sort of the position or the price that we would want to get quite aggressive on is probably about 39 Rand, which is a little bit above where it is today, but ultimately we believe it's trading at around fair value in our minds. So what we do is we independently value Outsurance, and then we apply, in terms of long-only money, we apply our own fair value to MMI and to Discovery. We believe that Discovery, possibly the value of Discovery could come down a little bit, and that's the value that we would apply when creating a fair value for RMI. And then MMI, we believe at the moment it's about at fair value. So in terms of whether or not it's offering value, we think on a relative basis, we do believe it is offering value.
Some who might argue, though, that they'd rather get into Discovery directly or MMI, would that also be a fair argument?
It is a fair argument if you don't want the exposure to Outsurance, but ultimately when you're buying RMI, the Outsurance exposure is what we're looking for.
From a global perspective, any other threats that might hamper their growth strategy going forward?
I think what they've just got to focus on doing, and it was something that was in the discussions that we had with management, is that they were possibly a bit aggressive initially in the writing of business in New Zealand. We think they've probably pulled back a bit. Some of that relates to marketing spend and possibly overspending a bit, but ultimately what they've got to do very carefully is not chase market share at all costs. So if they've got a successful model in South Africa, that's great to roll it out. But it's very easy to grow a short-term insurance business. You can write business till the cows come home, but you don't want to write the wrong business. So I think the biggest risk for them is their own risk appetite, to be honest with you.
What about consumer spend? We know that, especially in a country like South Africa, insurance is a grudge purchase. Could that also maybe hamper the number of clients that they take on, as you say?
I think they still have the ability to gain market share. I think in South Africa they are quite penetrated, being the largest direct players, and there is new competition coming in. But certainly as a reasonably small operator, as a percentage of the total in Australia, for example, if they've got a value for money offering, there's no reason why they shouldn't gain share.
Time now to hear from our experts whether to buy, hold or sell RMI as an investment case. And Liam, your view, buy, hold or sell?
So at the moment I'd be buying RMI. I think in light of our current market and in light of South Africa, there aren't many good stories out there. I think the growth that you're seeing within Discovery and Outsurance is something that excites us. And also to mention that the management team have recently raised about 25% of their market cap in debt. So the holding structure does give the management the ability to gear up. And that's about 15 billion rand, and we expect to see them make some form of value accretive acquisition over the next year. So in terms of the acquisition, we think that merely adds a bit of optionality. So if it's trading at or around our fair value, we're going to be happy buyers of the share.
Sean, I take it you agree?
Yeah, for me it's a buy. I think you've got a component of the value which potentially looks a bit expensive in the short term. Liam mentioned earlier that Discovery might come under some pressure. We think it's slightly expensive in the short term. Doesn't mean we don't want to own it long term. We do. We like it longer term, and it's a bit pricey right now. But outside of that, I think Outsurance, the implied valuation on Outsurance is fair to cheap considering the growth outlook. And as Liam says, if they spend that 15 billion rand wisely, it could potentially add another 10 rand per share of value in time. On a share price that's 40 rand today. So there's optionality in the business that you're not necessarily paying for right now. So I like it.
Well, we'll leave it on that note. It's a buy clearly for RMI coming out from both of our specialists who are from Anchor Capital. But that's where we leave it for tonight's episode. Do be sure to get in touch with us and share your views with us using the hashtag TalkingStocks410. But a big thank you to both our guests, Sean Ashton and Liam Hector, who are both from Anchor Capital. Until next time, we'll be talking more stocks.